Empires rise, empires fall. Wealth is created, wealth is destroyed. This cycle has repeated for centuries, yet every generation thinks their financial system is different. But history tells us otherwise. Let's dive deep into the big cycles that shape economies and stock markets, and how investing in tune with these cycles can make you insane amount of money. This video makes use of the framework designed by Ray Dalio in his book Principles for Dealing with the Changing World Order. Do check this book out, and please watch this video till the very end, as this knowledge is crucial to understanding the markets better. Successful economies follow cycles, typically lasting for 200 to 300 years. They alternate between growth phases of innovation and prosperity and downturns marked by recession, crisis, and financial turmoils. And history is full of examples of great empires that followed this pattern. The Netherlands was the world's reserve currency empire in the 1600s. The United Kingdom peaked in the 1800s but declined as US rose to power. The United States has been the world's superpower since the last 150 years, especially after the World War II, but are now on a relative decline. The Chinese are on their path to overthrow US, and India itself is on a rise. These shifts follow a very predictable pattern influenced by economics, war, and political changes. And these great empires have cycles that swing between two extremes, one being periods of peace and prosperity, marked by great creativity and economic growth, and the second is periods of depression, war, and revolution. These are characterized by destruction of wealth, power struggle, and life. The peaceful phase lasts 5 times longer than the crisis phase, but the latter reshapes history. Understanding these cycles help us predict market crashes, economic booms, and shifts in global power. If you enjoy watching such content, please like and subscribe. It really takes a lot of effort, so your like really makes a difference. Within these big cycles of empires are 3 major cycles. The first is long-term debt and capital market cycle. We will talk about this more later in the video. The second is internal order and disorder cycle. This cycle tracks the stability versus unrest within the country. And the third is external order and disorder cycle. This cycle tracks the stability and unrest among countries. These cycles dictate everything, from the market rallies and crashes to inflation and economic reforms. The post-liberalization boom of the 1990s created immense opportunities, but it also led to bubbles, scams, and financial crises like the Harshad Mehta scam and the 2008 financial meltdown. These 3 cycles swing back and forth between opposites, swings between peace and war, economic boom and bust, the political left and right being in power, forming and destroying of empires. An example of this is the forces that led to increased productivity, entrepreneurship, and capitalism, which marked the end of the 19th century, also led to massive wealth gaps and over-indebtedness, which led to a downturn in the first half of 20th century. This had led to anti-capitalism, communism, and big conflicts over wealth and power within and between countries. This is exactly what happened in India as well. The socialist ideology of Indians during independence was a result of the evils of the colonial capitalism. Then came the 1991 reforms, which opened up the Indian economy, unleashing a new phase of growth. Each phase was a reaction to the conditions created by the previous one. This swinging of conditions from one extreme to the other is why generations think differently. Our grandparents, who grew up in a weak on resource India and a stagnant pre-liberalization India, never imagined a massive economic boom, because an economic boom was more different than similar to what they had experienced. This is why saving in golds and fixed deposit was the norm. They feared instability. They wouldn't borrow money and put their hard-earned savings into the stock market. So understandably, they missed out on profiting from the boom. But today's generation, having seen a debt finance market rally and startup boom, would borrow a lot and speculate on the market and consider wars and depression unlikely, as these are more different and similar to what we have experienced. It is a fundamental truth that no economy, financial system, or reserve currency endures indefinitely. Yet market crashes always seem to surprise investors. The entire world, including India, underwent a severe stress test during the World War II. And the post-war era resulted in a period of relative peace and prosperity. However, after nearly 80 years of relative stability, the world is facing new economic and geopolitical challenges, indicating that prolonged periods of prosperity give way to new periods of stress. Now I'll be talking about money and credit to explain the first major cycle, which is the long-term debt and capital market cycle. Now this part of the video is extremely important, as understanding this is crucial to making money. Do not skip this part. Most people don't know the difference between money and debt, and it is extremely important to understand what money is, and I have done that in great detail in the video linked above, so I recommend you to go watch it. Money settles transactions immediately, and debt is a promise to pay in future. When money is borrowed in order to invest and earn a profit, and the debt plus interest is paid back, this is called a productive borrowing, and the society benefits from such borrowing as the society gains from its productivity gains. Real wealth is your ability to buy more goods and services. Hence, money and credit might seem the same as wealth, but are very different. You cannot simply create more wealth by creating more money and credit. The reason for this is also explained in the video linked above. This is why there are two economies, a financial economy and a real economy. But do we truly even know what economy is? An economy is essentially transactions over and over again. All the transactions within and by the country. So basically, for example, me paying in form of cash or credit to buy goods or services. So one person's spending becomes another person's income. The economy grows when productivity rises in the long term. The more and more goods and services produced by people, the more they earn. This is the productivity growth line, or the real GDP, or the real economy, where the only way to grow is to produce more. When you add credit in this picture, people can spend more than they can make because they have income plus credit. Credit, although, is essentially you borrowing from your future self. So if you are spending more than you can make now, you will have to spend less than what you make in the future. This quality of credit causes cycles in the economy, and this is what we call a financial economy. The economy has a short-term debt cycle which lasts for about 8 years and a long-term debt cycle which lasts for about 50 to 75 years. Examples of these could be the 2000 dot-com crash, the 2008 housing crash, the 2016 yuan devaluation, Brexit and demonetization crash, and the current market correction. If you notice, these were all 8 years apart, give or take. Credit in the economy delinks the real economy with the one we truly experience. This causes a large divide between the prices of things and the actual value of them. These credit cycles cause a great divide between the rich and the poor. The poor and the middle class end up paying more than the value of essential things like housing, clothes, or groceries. And the rich, on the other hand, end up earning more than the value of things, as they are the ones that generally own these houses and businesses and financial assets. The gap keeps widening, leading to a political left and right divide. When these incomes and political ideological gaps widen with an economic collapse, it completes one long-term debt cycle. Countries tend to steer out of this by printing a lot of money and lending money at a low interest in order to jumpstart the economy. This stimulation to the economy is like injecting steroids. In the near term, it will make the economy seem amazing, but in the long term, it will lead to hyperinflation, which will eventually cause the economy to collapse and leading to another turning of the long-term debt cycle. Countries can provide only a limited number of such stimulus packages, as after a point they stop working, as people and other countries lose trust in the said country's economy and the currency. And when this happens, the economy completely collapses. This is where the United States is headed. With an economic collapse coupled with an internal disorder, such as political divide or civil war, along with an external disorder, which could be a war or trade war with a challenging superpower, together leads to the end of the current world order and the beginning of the new one, with China at the top. If India really capitalizes on every opportunity, it might even be India at the top. These cycles have gone on forever and will go on forever. So what have we learned? History doesn't repeat itself, but it rhymes. Empires, economies, and currencies all follow cycles of rise and fall. Understanding these cycles can help us prepare for major changes. The next decade will define the future of global power. And you might be wondering, how must one invest in light of all this information? I've mentioned it in my diversification video. So that brings us to the end of the video. Do like this video. Thank you.